First of all, I would like to say hello and welcome everyone to the first workshop this year for the Nevada SSBCI TA program. You'll see on the screen here, there is a QR code. If you're not a fan of QR codes, there is a link just below it as well. That is the registration link that you will need after this workshop if you are interested in signing up for one-on-one TA. So basically what that is that you will meet at no cost with a SBC advisor, or consultant, which is the company that I'm with, and I'll explain that here in a minute. We are facilitating the SSBCI TA for the state of Nevada. And so you have lots of opportunities to meet with us. Like I said, it is at no cost, but you do have to register post-workshop in order to qualify for that TA. So today we are talking about finance basics for small business owners. And as I mentioned, this is only 1 hour. We are going to cover a lot of topics. So I am going to talk fast. The slides have a lot of information as well. After this is over, the slides are going to be available. I believe we have everybody's email. If you want that, we can certainly send it out to you. That way you don't have to spend all the time writing everything down. So hopefully that will help you out a little bit. My name is Christy Dudgeon. I am with SBC Consulting, as I mentioned before. We are a technical assistance provider for the Nevada SSBCI program. We are a group of entrepreneurs, all of us. We are also small business owners. We're all small business consultants on a full-time and part-time basis. And we assist small businesses throughout the country every day with
Mari on the site.
and problems.
Mari there.
Person, sorry, Sherelle, I'm gonna mute you. That you guys face, particularly with financing, legal. That's what the SSBCI program covers. So what are we covering today as far as our topics? As I mentioned, it's quite a few things. So different keys to success that we're going to cover are bookkeeping basics. We have a simple 4-step process that I'm going to go over. Business versus personal finances, how we keep those separate and kind of best practices there. The 3 key financial statements that all businesses need to know and understand, particularly for a financing aspect, as well as being able to better manage your business. And those are called your P&L or your profit and loss, otherwise known as the income statement as well. The balance sheet and also the cash flow statement. We're going to go over some cash flow basics and a rough 30-day planning that you can do from a cash flow standpoint, as well as just some information on budgeting for operations and growth. Then we're going to cover a little bit about funding readiness basics. So what do lenders look for and kind of what are those key items that you need to have prepared? And then more again on that free one-on-one technical assistance that follows this workshop. My slides are not moving for me. So quick chat check-in, if you guys can drop in the chat and let us know what stage your business is in. If you are in pre-venture, that's A. If you're a startup, that would be B. And if you're kind of in that growth phase, then go ahead and answer with C. So just drop that in the chat real quick and say hello to everyone. In the meantime, I'm letting more people in as the waiting room is filling up again. I do have Darlene and Denise from our team on here as well. They just waved and said hello. Denise does trainings in Spanish and English for us, and Darlene is in English. All right, thank you to all who's answering in there, and hello. So we're going to cover those bookkeeping basics, the 4 keys to success. I try to keep bookkeeping as simple as possible. I was an entrepreneur just like most of you. 25 years ago, I started out in my very first business. I had absolutely no idea what I was doing. I went to a women's business center and said, I need help. They matched me up with someone just like me, a consultant who taught me how to use QuickBooks, and I am forever blessed by the way that she taught me, because it was from a business perspective, not necessarily an accounting perspective, and that's how I teach as well. And like I said, it's from the simplest way possible because we're all out there trying to run our businesses every day, and we don't need to overcomplicate everything with our bookkeeping. More people in the waiting room. Look at this. This is fun. So, number one key, establish a very simple chart of accounts. Your chart of accounts is the foundation of any bookkeeping or accounting system, and keep it simple. So, start simple and keep it simple. This is where a lot of errors are made, and really, this is step one. It is kind of difficult when you don't really know what you're doing to say, hey, you're going to develop this entire foundation for your business. But if you enter it with, I need to keep it as simple as possible in the beginning, and I need to keep it simple as I move along, then that's going to help you out a lot. Second, you're going to need to categorize all of your transactions, and you're going to need to do it accurately. And we're going to talk about some keys to helping you do that accurately. Then you need to reconcile your accounts monthly. Don't worry, I'll talk about what these terms mean a little bit more. And then you also need to review your reports. So if you are doing 2, 3, and 4 consistently every single month, you will have up-to-date, accurate financial data that you can depend on. And you will also be able to generate those 3 reports that I talked about, and that we're going to go way more in depth here in just a second. So if we're looking at our chart of accounts, as I mentioned, you really only need to know 5 things. There's a little bit more than 5 things, but those 5 things are the keys to understanding what all plugs in to the rest of those chart of accounts. As I mentioned before, don't overcomplicate it. Keep it as simple as possible. When we're looking at what these 5 accounts are, or these 5 things we have to know, there's 3 of them listed on this page right now. Those are assets. They are things that the business owns, and they have a value. These could be your bank accounts, like your checking account, savings account, accounts receivable. That's something that you have if you're invoicing people and you're waiting for them to pay you. That's what accounts receivable is. This can also be equipment, so physical property type things, also property, right? So buildings and land. These are all considered to be assets. So that's things the business owns and they have a value. Next is liabilities. These are things that we owe and they also have a value. So these are loans, also known as liabilities, right? Credit cards, and accounts payable. So just like I had mentioned before, the accounts receivable, we invoice someone and we're waiting for them to pay us. That's accounts receivable. Accounts payable is when someone sends us a bill and we haven't paid it yet. So they're waiting for us to pay them. So that's what accounts payable means. Equity is the value of the business to the owner. So us as a business owner, the business is worth something to us. Equity is a little confusing, especially at the beginning, but it will explain that a little bit more and it'll hopefully start to make more sense by the time we're done. This is also how most owners pay themselves, or how to accurately track business and personal transfers, which I'll go into more in depth. If you're an LLC, a sole proprietor, or a partnership, this is where you typically would be paying yourself, or where you would be actually recording how you paid yourself. The other 2 of the 5, so we said assets, liabilities, and equity, are income. So this is the money in that the business receives in exchange for providing labor, producing a good or service, or through investing capital. So there's a few ways that a business can make money. These are also known as income, revenue, sales. So expenses is the last one of the 5, and expense is actually broken into 2 different segments, and I like to make sure that we talk about those, especially when we start to go into our chart of accounts. There is direct expenses. These are also known as your cost of goods sold, depending on which system you're using. QuickBooks calls it cost of goods sold. Others call it direct expenses. This is money out or money that we've spent or cost that's incurred by a business directly resulting in the revenue. So if we buy a product and resell it, the buying of that product is considered cost of goods sold or direct. If we had to produce that product, so the raw goods that we bought in order to produce that product, the labor that it took to produce that product, that's all considered direct because it directly influenced the outcome of the sale or resulted in that revenue. Indirect is the other type of expense, and those are what are commonly known as overhead, administrative, or operating expenses. These also, we say, are the cost of doing business. So these are things like advertising, insurance, rent, utilities. We would be spending this money as a business, unfortunately, that's just the way it is, if we were making money or not, right? So this is if we had an office, all those things we had to pay for that. I mentioned equity and understanding that a little bit more. It is very important to note, especially when we are starting out, that we need to get to the point very quickly, if possible, where we are not mixing personal and business spending. That's actually called commingling funds. It's very, very common to happen at the beginning because businesses typically aren't making money. So the money that is being utilized for expenses is often coming from us ourselves, right? As our bootstrapping of our funding. Then we might pull money out if the business makes money. And so the actual way that we transfer that money or spend the money could be perceived as commingling. And it's something that you want to not do because one, we need to keep business separate from personal, as well as it opens us up to audit questions. It also opens us up to liability the more that we are intertwined. And I know it's difficult because as business owners, our business is our baby, and it feels like there is no separation between the business and ourselves sometime, especially at the beginning. But we need to kind of form a wall if we can, especially in the financial world, between what is business and what is personal money. A couple people are unmuted and causing interference. Sorry about that. Let me see if I can catch who is unmuted. If you're unmuted at the moment, try to mute yourself, and that will help out. Thanks, Becky. Okay, so best practices, especially early on, if we can, is to go ahead and get a business bank account set up, as well as if we want to use a credit card, we can open a business credit card. Now, there are stipulations in the ability to be able to open these types of accounts. We obviously have to be a registered business. We have to have an EIN number. So we have to be registered with the IRS. But so if you don't have those, it might be difficult. However, there is a way to do this from the personal side as well. If you're not quite a fully operational business, is that you can have separate personal accounts, right? So this happens a lot with credit cards because credit cards are not necessarily easy to open up when the business is brand new. We don't have any kind of credit history on the business side. We can have a personal credit card though that we only use for business purposes, right? That's how we can work to keep those as separate as possible. If mixing happens, as I mentioned before, it's common, just fix it. You can use these equity accounts, as I mentioned before, to track money coming in and money coming out that has something to do with the owner. One of the most common things that I see is that we will use a personal credit card and buy things for the business because we were shopping somewhere like Amazon or Walmart that, you know, we might have been buying our own groceries and then we picked up a few things for the business as well. However, instead of paying our personal credit card directly from the business, the more appropriate thing to do is to call it an owner contribution or an investment for the amount of the expense. And we're going to make that transaction on the other side, say whatever that expense was. So if it was office supplies, so we've got an investment coming in, we call the actual expense the office supplies. So therefore the business has credit for the expense, the owner has credit for the investment coming in. And if you wanted to pay yourself back for that from the business, the most appropriate thing to do is call it an owner's draw or an owner's pay in personal. So that's the money coming back out. So you see the money come in through equity and you see the money go back out through equity as opposed to directly into an expense and directly back to you as an owner. It's just the more appropriate way to handle that, and it's much cleaner from a financial perspective. Important reminders: keep owner pay separate from business expenses as well. As I mentioned before, equity is where many small business owners will pay themselves as opposed to you giving yourself a paycheck. You're not necessarily a paid employee of the business. And the owner isn't necessarily a direct expense of the business either. When we pay ourselves through equity, so it doesn't matter what we pay ourselves for. If we pay ourselves regularly, we're not a W-2 employee, we're not taking taxes outright, that we would call that equity. If we're going on vacation and we just want to withdraw some cash from the business, right? The business doesn't care what we do with the money as an owner. That's why we just call it an owner's draw. Everything gets coded exactly the same way. Again, it's much cleaner that way. We do not categorize the personal spending as a business expense either, right? I said that. If we did use the business, I've worked with a lot of small business owners that say, well, I wouldn't make any money if the business wasn't paying me, right? I work for the business. And I get that. Just don't pay your own car payment or pay your own utilities or things like that that have to do with you specifically. Pay yourself as an owner's draw. So if you wanted to pay 5 or 6 bills or whatever, and they totaled up to be $400, just do a draw for $400 and then it would go that way. So I have a question from Allie that says, where do you note the owner contributions or draw? So in the chart of accounts, you're going to have a specific account, probably two of them in equity. One is going to be called owner's investment and one's going to be called owner's draw. That way that you can utilize owner investment for the money coming in and owner draw going back out. Why that matters: clean categories equal accurate reports and also better funding readiness. I started to say the reason that most business owners, or one of the benefits at least to the business of having a business owner not paid as an expense, the reason we are equity, is it doesn't affect the profitability of your company when the owner is paid through equity. So equity is actually going to be on the balance sheet, which you'll see that when we talk about financial reports, as opposed to be on your income statement where that's just purely income and expenses. Keep it simple. This is probably one of the most simplest narrowed down chart of accounts that you could see. Most small businesses only use a handful of accounts when they are categorizing their transactions. And they tend to be very closely aligned with these. We might have a few expenses here or there where we've got to get a little bit more detailed, but what I often see is sub accounts and extra accounts that really become so vague and so gray that even the business owner goes, well, it could be this one, but it might be this one. And if anybody is asking themselves that or saying those questions, that means you've got too many accounts, and there's probably two of them that should be merged together. I'll be the first to say that QuickBooks, when you set up QuickBooks on your own, they give you a ready, created chart of accounts. And unfortunately, there tends to be so many more accounts in there than anybody ever needs. So one of our first things that we'll do with someone who has set up a QuickBooks on their own is we'll go through and we'll help them merge and activate a lot of those accounts, because the more that you have in there, the more opportunity that you have to make mistakes and to make errors. And if they're inactive, then you don't accidentally choose them. I also like to look at it from the perspective of someday it is going to be everybody's goal to not be doing this on their own and to have a bookkeeper who is doing this for them or an accountant. And when you do that, you are then allowing someone else the creativity to potentially use one of those accounts. So it's highly beneficial if you go in and you inactivate, just as good practice. It also prevents you from having to scroll through all these extra accounts that you don't need when you're not 100% sure what those account names are. So back to keeping it simple. I'm sorry I jumped off of that. But you can see we have one asset account, which is typically our checking account. We may have a second one here because we have savings. This is saying that we don't own anything, and we don't have accounts receivable. So not everybody invoices, right? Credit card is our only liability on here. We don't have any other kinds of loans, and we aren't entering our accounts payable. Although it's good practice, especially if you're looking for funding, to have accounts payable in there. It just shows a higher level of record keeping when you've got that clock ticking. Owner's draw and investments, somebody had asked if the owner's draw was how they do that. That is an equity account. Lily, yes, I am sharing your screen. Can everybody else see that? Nobody else. Yeah, I see lots of yeses. So yes, it's up there, Lily. Um, Income sales is an income account. Sometimes this is just called sales. Some people will call this services. You don't need to break this out into a whole bunch of different sales lines for everything that you sell. Most of this gets lumped in. If you're unsure about how to set up a chart of accounts and you need inspiration beyond this, I always invite you to look at a Schedule C. If you've never looked at a Schedule C before from the IRS, that is what most small businesses, especially if you're LLC, sole proprietor, or partnership, then you would be using a Schedule C to file your taxes, and that is the simplest form of a P&L or income statement that you can look at. And you're going to see there is one line for sales, and then there is one line for advertising, and one line for vehicles, and it's all broken up on there. Ali asks, when you say account, do you mean like a column on the bookkeeping records? So an account is like a bucket, if that helps make more sense. So we're putting things in that bucket. Every single transaction, we're choosing which bucket that we're going to use. I'm assuming when Ali is asking if it's a column, that's probably a spreadsheet that you're referring to. So maybe you have a column heading, and those would be each of those buckets that you're putting it into. And then we've got the various expenses. So cost of goods sold, as I mentioned before, we definitely should all have a cost of goods sold. That is a major error that I see with a lot of businesses, is that we don't have a direct expense. Every single business has a direct expense of some kind that they have utilized in order to sell their product. Even us as consultants, even though our cost of goods sold is going to be very small compared to someone who sells products, it is still there. Uh, then we've got rent, utilities, insurance, advertising, software, and subscriptions. That's a huge one. Meals, business related, note that's there, not personal meals, right? Vehicle and travel, this one could be variable. We may be using our personal vehicles, so we're not going to have vehicle or travel over in our business books. We're going to be keeping our mileage on our personal side. That looks different on the tax return, as well as professional fees. If we're paying a bookkeeper, we all pay an accountant most likely, or we have accounting fees, right, when we're filing our taxes, or legal fees. Those are all professional type expenses that we could have. So those are the standard ones. As I mentioned before, double check that Schedule C. You might see other ones in there. But no matter what, when you look at a Schedule C, however long your chart of accounts is that you've created, they're all going to get shrunk down into those accounts that you're actually going to see on the Schedule C. So that's why I say keep it simple. Once you've gone past what a Schedule C looks like, you're just overcomplicating it potentially. Some of those are going to be really important from managing your business and really needing to see one of these line items. So I'm not saying you can't go past that. However, definitely at the beginning, keep it as small and simple as possible while you're learning to do this. So categorizing transactions, best practices here. Be consistent. So we're not confident in the beginning, and I understand that. It's hard to say, am I 100% sure that's advertising or is it an office expense? Which one really should that fit into? But from your perspective, it is best to just be consistent. If you've done it one way the month before, just stay with that, right? At least you know that from a consistency standpoint. And if you are talking to your accountant and you're trying to sort some things out, it's easier to figure things out and to separate them. Maybe the whole thing needed switched to another account if you were consistent with it. So keep the same type of expense against the same type of category. Categorize by what it was for, not by vendor. I do see that a lot too. So like with Amazon in particular, someone will create an account in their chart of accounts that says Amazon. It doesn't really tell us anything because Amazon can be a lot of different things, right? Use business accounts for business spending only. I can't stress that enough. So if it's a business expense, you definitely want credit for it. But if it was a personal expense, use that equity, call it an owner's draw, and get it out of there. QuickBooks, another thing that I drives me crazy about it is that they like to add some personal things under equity, and really you don't need to separate out things within equity for what that personal was. Remember that I said the business does not care what you do with the money. Once it crosses that line from the business to you, you can do anything you want to with it, right? You're the owner. You don't need to define it at that point. You only need to define detailed what it was if it was a business expense. Record transfers as transfers. We see a lot of errors here too. So if you're transferring from a checking to a savings, it's not income, it's just a transfer from one account to the other, and that doesn't affect your profit and loss or your income statement. We see this with credit card payments as well. Credit card, the actual act of paying a credit card is not a expense. It's the expense when you spent the money on the credit card. That's the actual expense that occurred. The paying of the credit card is just a transfer of the money. The same thing exists with the loan. So we need to be careful with how we're doing those. We see that with sales tax also. Unfortunately, we are only collecting sales tax for the benefit of the government, and then we are paying it to them on their behalf. We don't get to call that as an expense. Um, Payment processors deposits. We see this too a lot. With payment processors like Square or Stripe or even Shopify e-commerce, there are multiple things that actually are coming into those deposits when they come into your bank account. Those may include sales. There could be sales tax in there. Sometimes they split out shipping income because shipping income gets charged differently, as well as they probably have deducted their merchant fee out of there. So it's truly not fully sales. And at the end of the month or the end of the week, whatever your process is, you will need to split those out so that you can truly account for what the actual sales were. It's, as I mentioned before, it's a very common error. Sometimes we will go through and help you understand and set up what that journal entry can look like. And you can do it then once a month just by copying it, replicating it. If you haven't done it for the whole entire year for last year and you're worried about getting your taxes done, it can be done once at the end of the year as well to fix all that against your reports. But just be aware that it's there if you're using one of those payment processors. And then add any notes for unusual transactions. So if you weren't really sure what something was in the first place and you need to leave yourself a note so that you can go back and reference it, that way, if you get asked in the future by an accountant, probably, what that was, or if you're trying to remember, then you've got that little note there. There's a memo section on every single transaction if you're using software typically that you can add. If you're in a spreadsheet, just add a note against it. And then review any uncategorized items monthly and resolve. So miscellaneous, general, anything with the word un in front of it, those are kind of just bucket accounts that software systems will throw things into when they're trying to help you with AI or something like that. These are not appropriate accounts to utilize for the long term. They can be as temporary holding if you're trying to ask something from an accountant and you're trying to get a reconciliation done. However, you do need to go back and you need to fix those. So when you're looking at your reports in step 4 that I talked about, you'll see these accounts show up and just know that those transactions need further research from you so that you can put them in the correct bucket then. Common mistakes. I mentioned loan payments. Loan payments typically have principal and interest in them also. So the actual payment of principal to a loan is not an expense of any kind. You're just paying back the liability. However, if you're paying interest, there is an interest amount on there that is an expense that the business can take. So you'll want to split out the amount of that payment, and it typically happens every single month. Again, if you need help with the journal entry or an entry for the year, you're going to look at the account as a whole. How much did you pay in principal and how much did you pay in interest so that you can get that accurate in your books? Credit card payments, Again, those are payment transfer, not an expense. The actual every single time you use the card is the expense that you would want to be putting in those buckets. Transfers between bank accounts, I mentioned, owner's draw and personal spending from business accounts. Make sure those are flowing through equity correctly. Deposits that are not sales. So if you had a loan and there was a deposit on it, you certainly don't want to call that sales because you would be paying taxes on it, right? There's other ways that those need to be handled. Owner's contributions, I mentioned before, refunds. So if you return something or you get something refunded, that's not income, right? That's actually going to go back against the expense for the original item that you purchased and returned. Payment processor deposits, so Square, Stripe, PayPal, Shopify, I had mentioned those before, and I had a question, if payment processors are not just sales, what would they be categorized as? So whatever we're going to categorize those payment processors as depends on what is within those reports. So every payment processor is slightly different, but generally there is a sales involved. There is a fee involved. Sometimes there's an actual processing fee on top of a fee, right? And so we would look at each report with you to help you determine exactly how to set that up. And it's either going to be called a split if you're in a software, or you're going to do a journal entry periodically to fix that. So, and also just know that if it's not just sales, right, it's that means that your gross sales or your total sales that are coming in, those numbers aren't going to match that report either. So looking at those reports is important. I can speak from many years of doing this. The less amount of payment processors that you use, the happier you will be. Because if you are doing this process every single month with multiple payment processors, it can be a headache. But it is extremely important to do because you don't want to understate what your sales were or overstate your sales, right? You want your reports to be accurate. Sales tax collected, big one with sales tax. Often that gets, maybe it'll get collected and it's called a liability when we collect that. It's called a liability because we owe that to someone still when we collected it. But we might make that payment and we might call that payment accidentally an expense, which it's not. It's a payment against that liability. And so we'll often see a liability account getting really big, and then we'll see an expense on the income statement for sales tax, and we'll help you fix that. Equipment that might be recorded as supplies. So there's different thresholds in, and this is accountant specific, in something that would be called an asset versus something that would just be called an expense. And so knowing which one those are, but generally if it's carrying the word equipment, which means it's probably larger in value, those actually end up becoming assets as opposed to expenses. Personal versus business meals. This is a big one when it comes to tax time. And if you've done your taxes before, or you've had that's asked of you before, you're going to have to break down meals and say which ones were business specific and which ones might not have fit the criteria of the IRS. So there are two different ways that the IRS will let you take deductions on this one. One of them's 100% and one of them's 50%. And most accountants will tell you that you need to be pretty confident in what those numbers are. Vehicle costs. So as I mentioned before, mileage, fuel, repairs, it depends on who owns that vehicle, how that vehicle is being used, and how you're actually going to track this. So that is obviously business specific. I have my bank is a merchant bank. Is it better to use the bank itself to accept payments? I can't say whether it is or not. You know, everybody has different fees when it comes to merchant fees as to whether or not that makes the most sense for you. Convenience comes down to choosing those payment processors as well. So I would just do my research if I was choosing someone that I'm using for credit card processing and decide, you know, what makes the most sense for my business from both a fee as well as a convenience standpoint. Definitely look at what the time might be on the back end as well. So everybody is a little bit different with the way that their deposits are done and the fees are done as well. So one-off or special transactions, I did mention equipment, which are ultimately called fixed assets. There's something we own and they have a value. Tools, computers, vehicles, these types of higher dollar value items. These are things we are not going to call expenses. We are actually going to have to put a new account in our chart of accounts for these types of equipments because we want to track them from the value of the date that we purchased it. And then we get a deduction at the end of the year, or throughout the year, depending on how you do this, but it's called depreciation. So if you've ever heard of depreciation, it's a way that a business, we don't have to take 100% of the expense in the first year. We get to do what's called depreciating it out over multiple years. So we just kind of spread that expense over time. And that's very dependent on the value plus the life of it. So this is an accountant question if you're not sure how to set that up. New loans, lines of credit, these are things that need their own line in your chart of accounts so that you can see the principal balance. And as I mentioned before, you're going to pay against that principal and you're going to keep bringing that down. Grants, program fundings, refunds, these are all things that we are going to one-off. So quick chat check-in again. Which of these are you unsure how to categorize? Loan payments, credit card payments, owner's pay, payment processor deposits. You can say all of the above. So just mention where you're struggling there with that. As I mentioned before, step 3 is reconciling your accounts. So what reconciling means is we are just basically making sure the value of each bank account or credit card account, loan account, anything that has a value is matching what it should be. So there are lots of things that can happen throughout the month from a transaction standpoint that can make these values not be accurate. So this is where we catch our mistakes by doing this. This is the process of confirming the value of the accounts being correct. If you've balanced a checkbook before, which is less and less popular nowadays, but if you've ever done that process, you're literally going line by line and you're making sure what you have in your system versus what you have on your bank statement is accurate. So you are making sure that all those values are correct. And if there's something in there that's either a duplicate, there's missing transactions, there's transfer errors, bank errors, all these types of things can happen. If those exist, then we have to resolve those before our accounts will be accurate. We might overinflate our bank accounts or understate our bank accounts on our financial records, is why this is extremely important. So we just want to make sure we've got those clear. Then step 4, we want to review our reports. This is a very often missed step. One, we know our values are all correct now because we've done the reconciliation process. When we look at our reports then, we make sure that all of that categorizing work that we were doing throughout the month is also accurate. So this is where we can see all of our accounts lined up in our chart of accounts just by reviewing 2 reports. Our income statement or our profit and loss, those are the same thing, and our balance sheet are going to show us all 5 of those main accounts that I talked about before. And we're going to go a little bit more in depth into those reports. So we're looking to make sure our income looks reasonable. If your income is double what you expected, there was probably a problem. You might have double or duplicated it. That's pretty common sometimes when you're using those payment processors and you're making those entries. Major expenses make sense, so there's nothing out of line. Large amounts sitting in uncategorized or miscellaneous, this is where we have to resolve those in order to make sure we've got those in the correct buckets. The owner pay, transfer not showing as expenses, loan payments aren't being overstated. So we're just looking for things that are out of the ordinary. Now, the first time you look at this, the first couple times you look at it, you might not see any of these jump out, right? If you're looking at it with Darlene or Denise or I or one of us on our team, we're going to be able to pick it out pretty quick and say, okay, tell me about this, or let's look into that a little bit further because something looks wrong there. And then diving in and really seeing what's in each one of those to make sure it's accurate. Why this matters, catches errors early. This doesn't build up over time, right? We're trying to do this every single month and we're being diligent about that. If we're waiting until the end of the year, that could be a lot of information. We've worked with some clients when we're trying to get them loan ready that we're dealing with 3 years of information, right? Because sometimes we're being asked for information 3 years back. So try to stay up on this as much as possible just by reviewing these reports. It's not just to make sure that your data is accurate, but actually using these reports is going to help you run your business in the long run. It keeps your books accurate, it helps you trust the numbers, and it makes you more confident. and it makes funding readiness easy. So simple habit: categorize, reconcile, review, repeat every single month. That's the process in order to be successful at this. 3 key financial reports. I have mentioned them already: the balance sheet, the income statement, and the cash flow statement. Those are the 3 I'm going to talk about here real quick. If we're looking at financial statements here, I have my cute little napkin finance. If you've never looked at napkin finance, they're pretty cool. But they show all 3 of these reports and why they matter. So we've got cash flow, income, balance sheet. Why? Internally, we can track our growth. We can know if we have enough cash, and it helps us manage resources. So pretty powerful between those 3 reports. Externally, it lets our investors or banks know if we're a good investment, if we're a good risk for them, if they can manage, they can assess our management ability by looking at these, and also any kind of red flags. Also, it's a standardized view. You're going to get very used to looking at them the more that you look at them. Compare companies that are similar to yours. You can track your performance, and again, it determines if you're loan eligible based on these. So the balance sheet, as I mentioned before, this is assets, liabilities, and equity. It is what a company owes and what a company owns at any point in time. There is an equation to this. That's why it's called a balance sheet. It always has to be in balance. If you're using software, it generally does this for you automatically. But it is assets equals liabilities plus equity. So we've got those items that I mentioned before. It matters because it shows your overall financial health, and it helps lenders understand your risk. That's why it's important we've got these accounts in check and our values are matching every single month. It lets you review if your cash balances look right, your loan and credit card balances are accurate, your owner's contributions and draws are reasonable. And it lets you know, where does my business stand right now financially? Oh, lost it. Now we've got our profit and loss statement. This lets us know how much money the business made. This is the #1 most utilized report, and the one that most business owners are comfortable with. This lets us know the bottom line or our profit. Those are pretty common things. Does our income look accurate? Do we have major expenses that make sense? Is there anything unusual that's missing? And so the question is, am I making money? That's what most people are looking at that report for. Now, even if you are profitable on paper, have you ever been short on cash? This is a very common thing. We work with businesses that have, a great profit margin, and they go, but I have no money, right? So you may answer yes to that question. You may answer no. If you're new to business, you may answer not sure. And so if I've got a great profitable company, why do I have no cash? You have a report that you should be looking at regularly called your cash flow statement. And your cash flow statement is showing how cash is moving in and out of your business. So where is the cash coming from? Where is it being used? And it's broken down into these 3 groups. So we've got operating activities, investing activities, and financing activities. So the if we're looking at just our income statement or our profit and loss, remember, we're only looking at income and expenses. We're not looking at our loans that we're probably paying. We're not looking at those owner's draws that we're possibly taking. Those aren't showing up on our income statement, so those aren't affecting the profitability. You will see those on the cash flow statement, though. Our customers paying on time, our bills and debts draining the cash. Is cash flow improving or declining? I worked in a business one time. My boss was the best at just looking at how much money he had in the bank account and going and buying things. And of course, me on the back end sitting in the office was going, what are you doing? Because I already knew from an accounts payable standpoint how many bills we had coming up. I was also looking at accounts receivable, knowing, was there even any money going to be coming into the business in order to cover those bills that we had to pay? He was not looking at any of those. It was just me. And it was a frustrating place to be. So cash flow basics and creating that 30-day kind of plan for cash flow. It's all about timing. It's not about profit. So when cash feels tight, it's because income comes in after the work is done. Bills, payroll, taxes come out before you're paid, and one late payment can throw everything off, right? So a simple 30-day cash flow lets you look ahead, not backwards. So the reports are just telling us what already happened. Cash flow is telling us what's coming up in the future. So when is money expected to come in? So when are we going to get deposits? Do we have invoices out there? Do we have sales? Do we have an event that we know that is going to yield a bunch of revenue? When's the money going out? We've got a bill sitting here today that we have to pay in 20 days. So that tells us we've got 20 days until we have to pay that one. When is payroll going to happen? When are subscriptions typically coming out? What's our debt look like? When are our loan payments due? And then set aside for taxes. When do we have to pay sales tax? Is there income tax that we have to pay? Our payroll liabilities are going to come out at a certain time. And then what's left in all of that. And that's what guides us to know whether or not we can go out and buy that piece of equipment that my boss loved to do so much. That's what gives us a true representation of what the cash is. So we want to make sure that the money is flowing at all times, right? It also lets us know when we're going to be able to pay those bills versus not be able to pay those bills. And we don't want to get caught off guard. That's the worst thing as a business. And I can tell you, as a business owner, I mortgaged my house because I couldn't pay my payroll. I was one of those businesses. I was also 20 when I did that, but lesson learned, right? I had to pay my employees and I didn't have a choice. I knew that I wasn't going to get paid from a contract for another 2 weeks. And so I did what I had to do as a business owner, and that's what we all do. Why this works: it reduces surprises, it helps you plan expenses, shows problems early, and it gives you more control. If you can see 30 days ahead, it will help you make better decisions. So, definitely having that rolling 30 days just in your mind, even if you're writing it out on a piece of paper every month or updating it on a spreadsheet, is going to help you make those decisions. Budgeting is a big, scary word often. Again, I've worked in companies where there was mutiny from a particular family and that I worked with because they thought I was trying to control them by telling them what they could spend when. And it was just because I was helping them create a budget so that we could have, our day-to-day operating costs planned out. We could have regular expenses. We had growth goals that we wanted to achieve. We wanted to buy a new building. And so if you're budgeting and actually planning this all out, that helps you be able to achieve those things. It also helps you prevent those cash flow surprises that may come up, and it helps you decide when you can afford to grow or not grow. It also makes funding and financing easier. So if you've got a budget, you can also then forecast off of those budgets often. And these are things that they're going to be looking for when you're going for financing. So a simple budget just helps you grow without guessing. It is guidelines, as I mentioned before. There are things that come up, especially when you're doing this in the beginning. You're going to be adjusting things in your budget. Inflation happens. Lots of products went up, right? We weren't anticipating. Payroll changes happen. And so you're looking at that budget and you're making budget changes for the upcoming year in order to make sure that you're staying within line. So the difference between a budget and then that 30-day cash forecast is a budget is a plan. It's based on estimates. It shows where the money should go. It helps with planning. It focuses on categories. That 30-day cash forecast is just a short-term cash view. It's based on real timing. So things that you know are coming in or going out in the future. It shows where the money is moving, and it helps you avoid those surprises and focus on those dates. Using those two together is helpful in running the business. So a major question in all of this is, are you running your business or is it running you? Probably most of you are saying that right now it's running you. That's very common in the small business world. But slowly, with learning these types of things that we're talking about today and getting the help that you need, you can move from that it's running you to you start running it. Funding readiness, these are common things that you're going to be asked for if you want to have any kind of funding, if you're trying to bring on any kind of investor, venture capital, those types of things. You're going to see this list or variations of it to be very common. So that profit and loss statement I mentioned, the balance sheet, cash flow information, and or projections. So projections are looking forward. How's the business going to grow and change? Business tax returns if you filed them. Personal tax returns, these are often asked for as well. That's your credit worthiness. They're going to ask for that on both your personal and your business side, most likely, especially when you're new. in business, bank statements, debt schedules. So what do you owe and to whom? A business plan and some type of explanation then also in what you're going to do with those funds. Funding readiness basics. This is what lenders are looking for behind the scenes. They're really asking three questions. Can this business repay the money? Do they have consistent income, positive improving cash flow, reasonable debt levels? Do they have a plan, right? Even if none of this is happening yet, do they have a way to get there? And is it reasonable? Is the business financially organized? That's what the today was about, a lot about getting financially organized. So clean, accurate records, consistent bookkeeping, clear separation of business and personal. Does the owner understand their numbers? Can you explain income and expenses? Do you know where the money's flowing and going? Confidence in your numbers and clarity matters just as much as the numbers do. So, how can SSBCI assist you? So personalized one-on-one support, remember, it is at no cost. Just a few things that we can help with: organizing and cleaning up your business finances, setting up and improving bookkeeping systems. I had a question in the chat that I saw roll by. What's the best software to use? We teach QuickBooks basically in our sleep at this point, just because we do this so often. However, it is not the only software that is out there. It is one of the more costly ones. So if your business is not ready for that, we understand that, and we do not say that you have to use that in any way, shape, or form. A piece of paper is a great place to start. A spreadsheet is the next level up. Google Docs and Excel both have a financial type record keeping. These are all very manual, though. You're going to be writing everything down or typing everything in, right? The jump to software. Wave is one of the cheaper ones that's out there. You can get a free version of it. It doesn't have all the capabilities. Then you've got to up. The reason that we teach QuickBooks is because wherever you are today and wherever you're going to be in 20 years, QuickBooks is going to grow with you. You don't have to transfer data. It's also simple to learn. It's also the most adaptable of those out there. Xero is another one. So we can definitely go over the pros and cons of the different softwares out there with you and help you make that decision if you want to jump into software. But don't be surprised if we're like, just do QuickBooks, because it's going to connect with a lot of things that you're trying to use. It's also going to have some cons along with it, just like everything does, and we'll go over that with you as well. Understanding your financial reports. Maybe you already have software and you just need to know from that next level. You've got the bookkeeping down, or you have a bookkeeper. You just want to be able to better manage your business and make business decisions. You're trying to get somewhere. We can help you understand those reports as well, and help you learn how to make those decisions better. Build a business plan with financial projections. You might be at the beginning of seeking funding and you need that as well. Preparing for financing or funding applications. That can be daunting, right? Maybe you've already gone to a bank and they've given you a giant list of things, and they said you have to get this ready before you come back and talk to us. We can certainly help you there as well. Get clear on credit readiness. So as I mentioned before, they're going to probably check your personal credit, and if your personal credit isn't ready for funding, we can help you with credit repair ideas, guidance on that, what you can be doing in order to help you bring that personal credit score up. And then also create an action plan. This is the biggest one with SSBCI, is maybe you're not ready for funding yet, but it might be something that you're going to be looking at in the future. Not everybody needs a loan, right? But we can help you create an action plan to help you get your business where you want it to be before you maybe reach that point with funding. So definitely use that QR code that's right there, or type in the link. There is no cost to you, Crystal, as you just said. It's all funded through SSBCI, which is a federal program through the Department of Treasury. Every state has their own SSBCI program right now. Nevada's got an awesome one rolling. And so use it, right? Take advantage of it while it's here. And all you need to do is sign up, and then one of us from SBC will be reaching out. Most likely Darlene is helping with intake. So she will be one of the people that you will probably talk to first before you're with another consultant. So any questions that anybody has? We have about 4 minutes. Um, Feel free to drop them in the chat, or if you want to unmute, that might get a little crazy since there's quite a few of you on here. However, I'll try to answer as many questions as I can in the next few minutes. I'm glad that everybody is liking the class. So, Becky, if you're not from Nevada, what state are you in? Because as I mentioned before, every state has their own SSBCI program, and we can help direct you to the right spot. Massachusetts. I'll have to get back to you on that one, but I will catch your email, I think, and try to get you who the contact is for that state. Unfortunately, it's not us in Massachusetts right now. So everybody that signs up for this, that's a great question, Allie. It's all virtual meetings. So we do Zoom meetings. They are flexible. You will be given a link to your consultant's calendar. You will choose whatever time works for you the best on their calendar. There is no set time that you have to meet with them or a set number of times. We manage the time with you based on what it is that you need and how many of you that we're helping at one particular time. So obviously it is our goal to get you to where you're trying to get throughout this program. And so your consultant will help you manage that, but you will have full control over when you schedule with them. So the recording of this is actually going to the Nevada SBDC, who is helping facilitate this. So they're going to have a copy of it. I'm not 100% sure where they're going to share it or if they're going to share it out to participants. So I would circle back with them. Also, obviously, if you are signing up for TA and you haven't been able to, you don't know where the recording is, certainly ask your consultant, and they will help you get a copy of it as well. So external grant funding, I have a question. That is not income. Grants are handled different. Actually, that usually gets logged under other income. And you probably are going to have a line item specifically in your chart of accounts that is saying whether it's a restrictive grant or a non-restrictive. I'm assuming your maybe nonprofit is the reason that you're grant funded. If not, again, that's something we can help you work through to make sure that that is recorded correctly as well. Grants are definitely handled a little bit different. Do we have any other questions? I think I keep catching them. If I missed yours, just drop it back in the chat so that I didn't miss it. Oh, I see one back here from Sarah. Sorry about that. How would service and sales be differentiated if a customer provides materials for something to be made? So service and sales, if you have two very distinct lines of revenue or income, we will seed two different accounts for those because often businesses need to know what the revenue generation is from one of those two things, right? So you would log sales or categorize sales or classify whatever word you want to use there as whether it was sales from service or sales from a product. And if you were setting up something like QuickBooks, that basic chart of accounts structure that has all those extra accounts that I mentioned, they actually put like 5 or 6 different sales in there. And we would help you pick which ones you should be using or not using. But definitely service and sales. You might have multiple income. And as I mentioned, if it is so distinctly different, that's the question to really ask yourself when you're setting up those chart of accounts. If it's so distinctly different, to make sure that you've got lines for that. You are welcome, everybody. Thank you for all of that. I think I caught everything. We will be following up with you guys if we haven't heard from you, just to make sure that you're okay and you don't want to sign up in the program. However, if you do sign up, you probably won't be hearing from us. As far as the follow-up, you will hear from us to let you know how to schedule. But thank you all for joining, and we are at our time now. I appreciate you all for being here. Sadie, it says you can't sign the application. Is that when you hit the submit button? That's important to know. Oh, Hallie said she didn't need to sign it. So maybe just hit the submit button instead of signing. See if that worked. Oh, you got an error. Okay, let me send that note to the SBDC. I've got your name, and I'll have that noted that you weren't able to hit the submit button. All right, thanks everyone. Bye-bye.